Okay, to the business at hand. We're very pleased to have with us today Jay Pelosky, proprietor of TPW Advisory. I've known Jay for decades. We're getting old, Jay. I knew him when he was a major domo at Morgan Stanley, trafficking emerging markets and a globe-trotting investor. Always has really interesting insights to share on this topic. Couldn't think of anyone better to have given what's going on with the so-called U.S. exceptionalism. And we talk a lot in this room about um, different perspectives, and it's with good reason. People have been very focused on the U.S. markets, what they know best. Also, quite candidly, the last 15 years since the GFC, there's been little reason to diversify. I joked with Jay a few weeks ago when we did a YouTube. I said, Jay, if I can lose money between 9:30 a.m. and 4 p.m. Eastern Standard Time, and I don't have to be up at night following the Japanese market, go for it. Well, the tectonic plates have shifted massively in the last few months, and Jay got out in front of this. He's kept his clients in good stead at TPW. And so he's had a hot hand. Of course, market's seeing a little bit of upset right now, but I think the song remains the same as far as Jay is concerned. So, Jay, good morning. Please unmute yourself. This is your first time. You're on Spaces. You have to hit the little unmute button. Right now, you're muted. Um,
Is that better?
there you go. Hey,
There you
there it
go.
is.
Look at that.
So
Look at
Jay,
you
yeah, there you
go.
go. Boy, it wasn't that was really tough. So, Jay, I have to restrain you. We're not going to be talking about all things Duke this morning. So
Oh,
if you could just
okay.
hold the Duke basketball and football comments till later. However, um, if you're not going to say it, I'm going to play a clip or two from our interview we did a few weeks ago. Some of the word choice, given that this is a relatively smaller audience. But in any event, so welcome, Jay. A lot has happened since we spoke a few weeks ago. And again, for all of you, if you go on our YouTube channel, Dilly, maybe you can put it in the nest. You can actually see Jay, and he held court for about an hour with Michael Kramer and myself. So anyway, so Jay, I deliberately chose the song "Living on a Prayer." Maybe I'm being a bit too harsh. I don't know, but
I like
I,
it.
when we were talking yesterday, you were saying, "How does this work?" And I said, "Well, I'll just introduce you, and you can kind of let it rip." So. Um, a lot's going on. So certainly different than investors have become accustomed to with post GFC era. So maybe just stand back to kick it off, and you can ramble for a few minutes, or we can kick questions back and forth. Like me, I'm never shy with questions. So I yield the floor to you, Jay, and it's big picture. Where are we coming from here? And everyone wants to get so caught up in the day to day volatility, the trade, but there's really, I think you and I both agree, there's a big structural thing going on here, which is far more important. So with that, Jay, please take it away.
Great, George, and thanks. And hello, everyone, and good morning. Yeah, 8 a.m., right? George always like to get started early. That's a Japanese market in him. He's up early, so everybody else should be too. I think you're right, George. I mean, my whole view is that, to put the headline up front, is that we're at the beginning of a secular change in global equity leadership away from the United States, which, as you pointed out, has been the undisputed leader since the low in '09, the great financial crisis, from the U.S. To the rest of the world. And, you and I, again, know from experience that when these changes take place, they don't last for a month or a quarter or two. These last for years. And so for example, prior to the 15 plus year run the US has had, the non-US markets outperformed for 6 or 7 years. Really, again, similarly, from the dot-com bust up until pretty much the GFC, non-US markets outperformed. So, that's been our view now going on, 6, 8 months. And so, yeah, we have been kind of positioned. And I think it's important. Well, first of all, it reminds me of, living on a prayer. It reminds me of a saying that I used to hear way back in the day at Morgan Stanley. Maybe you heard it too. Is that, when hedge funds felt they were at the beginning of a bull market, the senior guys wanted to get a kid, right? That was the phrase. We got to get a kid. And they wanted to get a kid because the kid had no memory and could just be uber bullish, which is what you want to be in a bull market. And it struck me this morning that as I was thinking about this kind of preamble, that what you want now is a couple of old guys, because we're the only ones who remember what it's like to be in a global equity marketplace where non-U.S. equities lead. So you really do need, you need some experience. And I think you also need a framework and a process. And so, I'll segue into our latest thoughts through touching on our framework at TPW Advisory. And so I've been doing global macro, which is what we consider ourselves to do, global macro investing, really since the mid 90s. And I start the clock when I was asked to kind of serve as Morgan Stanley's co-head of global emerging market research. And that was the firm's first multi-asset, multi-regional research product. And from there, went to global equity strategist. And my last job at Morgan Stanley was head of global asset allocation. And this is all now 20 plus years ago. So for the last 20 years, managing my own capital and doing various advisory boutiques, working with hedge funds, institutions, high net worth individuals on portfolio strategy and asset allocation. And now today, and for the last several years, I run TPW Advisory. And TPW stands for Tripolar World. And that's our framework. So importantly, when you think about, okay, how do we start to consider this global opportunity set? At TPW, we've been doing it for decades. And TPW itself, the tripolar world thesis, which is regional integration and deepening in Asia, Europe, and the Americas, thus the three poles, is the operating system of the global economy going forward. That's been our framework for 15 years. I started writing about it in 2010 as a kind of a reply to the monetary policy focus coming out of the great financial crisis, that we needed more than just monetary policy. So we have a framework that we've been developing for over a decade. We also have a structure, which we call our global risk nexus, which looks at climate, economics, politics, policy, and markets in each of the three regions and globally. And we have a process, which is we write every week. So our clients on Substack at the Tripolar World get a weekly update. We call it our Friday Musings. And every once a month, we do a monthly deep dive. And we also offer model portfolio delivery services with two models, a global multi-asset and a thematic TPW 20 model, all U.S. listed ETFs, 100%, as I say, in the U.S., 25 to 30 in the global multi-asset model, 20 only in the TPW 20 thematic model. And we update the models the week after we do the monthly, which is actually tomorrow. So the monthly we published on Friday, and I'm going to walk through the executive summary real quick, and then we can open it up to your questions, George, and audience questions, and hopefully I'm sure there'll be many. The title this month was Forged by Fire. And the monthly this month was 6,700 words, 33 charts and tables, excuse me, from about 20 different research sources. So it's a lot of work. But what it does for us, we write really for ourselves. Okay. It helps us get all our thoughts in order and organized. And then once we do the monthly, we're primed to then update the model because our thinking is current. It's as fresh as it can be. It takes from all our sources. We organize it, put it together. It's all coherent, which again, in global macro land, particularly when things are moving as fast as they are in Trump time, you need to be organized. You need to have a framework. Otherwise, you're just chasing the latest thing. And, that's not a recipe for investment success, particularly not today when, markets can move 3, 4, 5% in a day. So what's our takeaway from our monthly that we published on Friday in our Substack, the Tripolar World? Started off, investors need to assign a Trump discount to U.S. economic and earnings growth, and hence to U.S. equity upside. They need to establish a Trump premium to the cost of capital for U.S. companies and households. Talking interest rates here. And a Trump discount in the relative value of the U.S. dollar. And that's what's unfolding, right? To just put it really, really straightforwardly, the U.S. exceptionalism argument, which, was perfect to culminate 15 years of outperformance. We went from U.S. outperformance coming out of the great financial crisis to the Magnificent Seven being the epicenter of U.S., what made the U.S. different. We had the tech, nobody else did, pushed up valuations to, classic blow off top, American exceptionalism. And boom, all gone. So we're just early in the unwinding of basically 15 years, and I would really say 5 years post-COVID of U.S. kind of exceptionalism, which is basically, in our view, simply fiscal utilization. We basically used the fiscal space we had to spend more money than pretty much everybody else post-COVID, and that led to faster growth, stronger earnings, higher stock prices, premium valuation, sucked everybody in from abroad, strengthened the dollar, and boom.
Jay, I have to interrupt you for 1 second. I'll let you take a breath. I
George,
love
I've
it.
barely gotten started, buddy.
I know, man, dude. It's all
Dude,
yours.
I'm like not even my second bullet point.
Dude, I
Go ahead.
understand. I was gonna.
Go
I
ahead.
love the way. I guess it just shows how when you grow up, you have a respectable job, and talk to respectable clients. You say fiscal utilization. Okay, translated. You know, irresponsible fiscal spending like a drunken sailor, like El Busto Mundo. Just so people understand what fiscal utilization is. It's just spending irresponsible budgets. Just so we're clear on that. But kudos to you, Jay. It's much more the way you play is much more acceptable to play company.
There you go. So the silver lining to what otherwise would be perceived if you were a U.S. equity only investor is that this now represents today the best time in the past 15 years to be a global investor. And that's really like, if there's only one point anybody who's listening takes away from this, is it's the best time in the last 15 years to be a global equity investor, because it's the first time in those 15 years that the non-US equity markets are leading. Okay, so how are we dealing with President Trump and Trump 2.0? We wrote a piece again on our Substack now probably 6-8 weeks ago called Stoic Strategy. So we went back to the ancient Greeks, the Stoics, and recalled one of their key principles, which is to imagine all scenarios, and thus fear none, because you've already imagined them, and it's not going to be a surprise. And back in the day, and George, I think you and I talked about this in the YouTube session, back in the day, the Greeks were worried about shipwreck and war and slavery and things like this. And all we have to worry about is, investing in the Trump age. So it's really important for us. We want to cast a wide net in terms of our thinking. Then we had several principles. We wanted to ignore, and I think this again is really important, ignore the presidential verbiage, both of the president and any of his cabinet members. Because,
Jay, that is one of the best points I took away from our interview. Sorry to interrupt you, but
yeah,
in practice, I mean, that is so important. But in practice, when you speak to clients, how easy is it to achieve that goal? I mean, people just get so triggered. I just think so many people are clouded because of the emotion surrounding the president. No.
yeah, well, not only that, but just the fact that he just constantly is sprouting stuff, and he has to, it's a personal failing of his. He has to be the center of attention. And so he creates that dynamic, and tariffs are actually I think there's a part of the reason for the love of tariffs for Tariff Man is because he gets to be like the king. right? He gets to dictate what's going to happen, and everybody has to wait for him and talk to him and all the rest of it. So, what I think, though, as an investor, is that it's a superpower if you can ignore the verbiage because it allows you to focus on what's happening elsewhere, like in Germany, right? Where they're going to spend more money than they've spent in decades, or in China, where they continue to stimulate the market and protect against downside risk in their equity space. And so you can't do it all. You have to pick your spots and ignoring the verbiage because it changes from day to day. So it's really useless trying to like pay attention to it. And it allows you to focus on other things. So that's a superpower. And so what we want to do is pay attention to the action and ignore the verbiage. And we want to pay attention not to the news, but to the market's reaction to the news. And this was really critical a couple months ago, like an early signal of this leadership change was, Mexico being in the crosshairs of Trump day after day, tariffs, etc. And, what happened to the Mexican peso? What happened to Mexican equities? They were fine because it had already been priced in. And so they did not go down on what would appear to be really negative news for the Mexican economy and Mexican financial assets and the currency. So, that's the importance. You want to pay attention to the market's reaction. So we believe over the last week or so now, kind of fast forwarding to, the immediate recent past, that it was the U.S. Treasury market that forced Trump to reverse his Liberation Day tariff onslaught. And we think that because we believe what's most important to Trump is tax cuts. He's going to do what he's done before. Trump 1.0, pretty much the major accomplishment in the eyes of the administration, was a major tax cut. Trump 2.0, the objective is another major tax cut. And so we have had a view from the beginning, i.e., the last 4 months, that tariff revenues are simply a money grab to generate monies for providing space for a big tax cut. In the Doge savings, such as they are, or were considered to be, likewise, just providing fiscal space. So back to fiscal space. And so the only way that big tax cuts can happen, because there is no space to have them be unfunded. We're already operating at a 7% budget deficit. They have to be financed. And in order for them to be financed, the Treasury market has to be copacetic. And the Treasury market not being copacetic means there's very little room for the tax cuts. And we think we're switching from the tariff focus to the tax cut focus, because we need to move forward on this in the next couple of months in order to have all the timing sync up. So in the same way, the same vein, the Powell talk is also kind of useless talk, not really worth paying attention to. Because again, if you try to fire the chair, the Treasury market is going to explode. And if the Treasury market explodes, there's no tax cuts. So this is just Trump kind of jawboning, and he's pissed off, and he's got very little else to do, and so he's taking it out on Powell. So we believe, and this is now important from a tactical point of view, we believe that the worst of the Trump tariff strife is behind the markets, and that Trump will spend most of these next few months ratcheting down the tariff heat, including with China, who we believe has more leverage in the trade talks than the U.S. And we can get into that if it's of interest to folks. We agree, and George, I'm kind of coming towards the end of, well, not exactly, a few more points, but we believe that much as the guy who I like, who I think really has an edge on this stuff, is a University of Michigan economist, Justin Wolfers, who folks on Twitter might have seen, he's pretty visible. And his view is that Trump is going to basically bring the tariffs back close to where they were before he started this whole thing and declare victory. And that makes sense to me. So it's going to be a Pyrrhic victory, right? I mean, the end result of the tariff saga, in our view, is the following: a weaker U.S. economy, weaker U.S. financial market.
Pardon the interruption, but the audio crashed in this space recording. So the next segment will be starting now.
When we spoke to him, there really wasn't even anything happening in the markets yet. So um, it just kind of gives you a sense of maybe where you are in the cycle.
Yeah, we're still early. This is like first inning. Maybe we're out of batting practice.
Wow.
No, I
Well,
mean,
All
you
right,
look
Jay,
Jay.
seriously, you look at you look at a long-term chart, like you look at a 15-year chart, a 20-year chart. I mean, it's barely noticeable, the outperformance we've had. So
Yeah,
it's
Jay.
noticeable in a very, like, month or year to date span, yes, but and so yeah, I was just about to kind of get to. I don't know where we dropped, but I was kind of about to get to
We
the
can
tactical
blame
side.
we can blame Doge for the drop. So
Yeah, there you go.
the
Perfect.
space is crashing. Yeah.
All right,
George,
so
where should I pick up? I don't
yeah,
know
yeah.
where I've
So
dropped.
that might be a good place to pick up, Jay, where we are
Sure.
early. And the other thing I'm going to put, by the way, there's something called the Nest, which I don't know if you'll be able to see it, but there's this area at the top of the page where if you touch it, you'll see some images appearing. I've taken the liberty, with your permission,
Yeah.
of trying to put some of the slides in, so highlight
Perfect.
some of the stuff. But I think another thing that I was really struck by it's not just equity outperformance. I mean, okay, let's be fair. I mean, we know U.S. earnings have really outperformed rest of the world earnings, all right, and that's been largely due to Mag 7. If you look at the 493, not
Yeah.
so much. And the second part of it has been, of course, how U.S. valuation has expanded so much relative to the rest of the world. And so,
Yeah.
if you get multiples going sideways, or God forbid compression, as has been the case, and as you will explain further, you get, before, the only game in town was, I'm just trying to set it up for you, make it easier. The US, it wasn't a lot going on in the rest of the world. So it's US exceptionalism, Mag 7, these wonderful companies. Rest of the world, not so much. Now you got a fiscal impulse in the rest of the world. So, you from a starting point of the US is very expensive, way overowned. You now have stories emerging elsewhere. What I found particularly compelling, Jay, when we spoke a few weeks ago, which I didn't fully appreciate, and I think the listeners would really benefit from this, because this is the kind of stuff that they could get from you and not a whole lot of other people. But share with us your views as to, in terms of the capital flows. You had thrown some mind-boggling numbers at Michael and I about how many trillions of dollars had flowed to the U.S. And if just a small percentage went back, if money go home, everyone goes. Michael always asks the questions like, "Where's the money go? Does it go to money heaven? Does it go money go home?" Right.
Right.
So, A, the capital
Right.
flows, and B, just how, and not that fair value counts for much, but just how overvalued the dollar is by most, serious students of it, and therefore the scope of the dollar to fall just to reach fair value. So,
Right.
capital flows and the level of the dollar. I think people with a sort of U.S. centric focus, they don't understand that. It's not something they ever pay attention
Right.
to.
Right. Yeah, and I think that's those are critical issues, right? So our view is that this secular change in global equity leadership away from the U.S. back to the rest of the world, both DM, ex-U.S., and EM, is going to be underpinned by a sustained period of capital repatriation out of the United States, back back to Europe, back to Asia, back to EM. And again, it's just an unwind of what has taken place the last 5, 10, 15 years. As I said, 15 years of outperformance, massive outperformance, really separation kind of post-COVID. George, you called it earlier, irresponsible spending. I don't go quite that far. I think for the most part it was responsible spending. We could quibble over that, but the end result was the U.S. grew much faster than the rest of the world, and earnings grew much faster, and stock prices did much better, and it sucked in all the capital. right? So everybody had to be invested in the U.S. and therefore, it's the typical stuff of what happens. You have a long trend, it builds on itself, and it gets overvalued. It gets kind of crazed, and then it falls apart, and that's what we've had. I think there are two things, right? DeepSeek, the China AI, in our view, shot a hole in the heart of American exceptionalism, which is big tech. We're the only ones who had tech, supposedly. And then, boom, China says, hey, we got tech. And by the way, it's like 70% cheaper than your tech. So we've had a classic rotation out of U.S. big cap tech into China tech. And, we've been big fans, big believers, and have good sized positions in KWEB, the China tech ETF, for over a year. And if you look going back a year, KWEB has massively outperformed the Qs. So it's not just like the last couple of months, it's been a year. FXI, by the way, the China large cap, has massively outperformed the S&P. So big DeepSeek shot a hole in American tech exceptionalism. And then Trump has come and basically blown up, the idea of the U.S. as a safe haven, as a sober-minded place where policy gets done with, for the most part, pretty good execution and for, somewhat reasonable objectives. All that has been called into question with Liberation Day, with, basically threatening to fire your Fed chair, your central bank chair, and talking about a weak dollar and all the stuff that's happened. We don't need to go into the details. But the end result is, okay, people are like saying, oh, wait a sec, I'm way overweight here. It's underperforming. The dollar is going down. So this is critical. And I think, George, you and I touched on it last time. If you're a yen-based investor and you're invested in treasuries or in equities, and your currency has fallen 10 or 15% versus the dollar, you don't just get the S&P 20% gain. You get the S&P 20% gain plus 10% currency on top of it. That's all going in reverse. So now the yen has appreciated against the dollar. That means the dollar returns, which let's call it down 10% year to date, is actually down 20 if you're a yen-based investor. So, that's why this stuff kind of feeds on itself.
Jay,
And,
Jay,
go ahead.
could you just to pile on that a little bit? It's the old Wayne Gretzky line, don't go where the puck is or where the puck's going. So hallucinate a little bit about, prognosticate a little bit about um, where the dollar could go. I think you quoted some statistics from Stephen Lee, Jen, and Michael, and myself, his
Yeah.
forecast. So we become so used to this weak dollar, and people are like, oh my God, the end's at 140 down from 162 or whatever it was. It's like there's a lot more where that came from. Can you just talk a little bit about it doesn't be your forecast, but potentially like where fair value is and potentially where it could go?
Yeah. And let me caveat or set the stage on this with some tactical thoughts, right? So strategically, i.e. multi-year, secular, DXY could go down considerably further, right? DXY is what a lot of folks use to kind of talk about the dollar. It was at 110 last fall. It's now breaking 100. We think it's on its way to 90, give or take.
Hey, I hate to interrupt. George, the space is glitching, and so the listeners can only hear about 50% of the words.
Oh, God.
I think we need to restart again.
No. Hold on. Michael Kramer, can you hear me? Michael?
He will be able to hear everything because he's a speaker, but the listeners are all reporting down below that they can only hear half of what everybody's saying.
I don't want to have it again. I mean, Jesus.
Yeah, just restart it. It rip the Band-Aid off. It'll be fine.
Okay. Hold on a second. Dilly, how many complaints have you gotten? But
there's about 6 of them. This is a common glitch that happens sometimes.
Yeah, hold on. If anyone is having trouble hearing, could you please?
We already have thumbs up.
I don't.
And 100%.
George, let's just go ahead. Just send me the link. I'll come back on. We'll pick it up here.
Sorry.
And this will be.
Yeah, I'm sorry, Jay. This really sucks.
Yep.
All right.
It's Elon. It's not you, George.
All right, Jay. I'll send you a new link. All right. Yeah.
Yeah.
Bye.
No worries. Ciao.
Again, there was an audio crash here, so we will move on to the final segment.
Jay to show up. I'm absolutely thrilled. I guess I heard he was in a bad way, but I see Van has reappeared. He's been gone for about a week, and I was really getting worried. Van, how have you been, my friend? We were missing you. People were asking me, "Have you seen
We've been
Van?"
alone.
Yeah, Van, what's been happening, man? What's going on?
Well, before I kind of fill you in on what happened, I want to apologize to everybody for the market being down yesterday. I was out at a bar and I was at the jukebox trying to pick out a Springsteen song. And the next thing I know, I was in my office. I was actually taking risk off my Bloomberg terminal. I wondered why my jukebox wasn't accepting my $5 bill because apparently I wasn't actually at the bar.
What?
It looks like I accidentally sold about $9 billion worth of risk. Thought I was at the jukebox picking out a Springsteen song, and it turned out it was my Bloomberg terminal.
Wait, Van. You mean Van? You were responsible for the sell off yesterday. It was a fat finger.
He did apologize. He
I
came up to
I woke
apologize.
up about 9 billion later.
Oh my God! So what did you do? You letting it? You staying short, or you covering it? What are you doing, Van?
Let's just say today's a little bit of a reassessment, but my absence, unfortunately, I was checking out some investments in China, and I ended up in a Margaritaville in Macau after missing out on a back rack table. And once I sobered up long enough, I figured I would come on here and check in.
Van, how's the whole China upset been impacting you? I know you always have good connections with PBOC and also your friends at BOJ. I mean, you've made your career there. So, what are you hearing? So, maybe you could help us common folk, Van. What are you hearing these days?
Um, well, I'll fill you in on my China adventures, but I see Jay's back.
All right, Van. You hang around. Maybe put some coffee up. Maybe sober up a little bit, and when Jay's done, we can talk some more. So Jay. So
So
Jay.
George, you provide audiences that are that are feeling a certain way.
Yeah,
That's
well,
great.
you know,
Old school, baby.
yeah, well, Van, we were getting. I don't know if
Late
you've.
nights.
Yeah, I don't know if you saw his. It's. You should look at Van's profile. This is Van drunk. This is Van Drunken Miller,
Yeah.
world renowned speculator. And just so you know, he's agreed to join us. I think it's going to be next week, but we also have Dilly. I think we can let one of the names slip out, right? I mean, we're gonna have
Sure.
Howard Nutkick join us and talk about his views on trade. So we're hoping to get some of some really
I
well.
really got to say some stuff to Howard Nutkick, okay?
All
I
right,
got a lot to say to that guy.
all right.
Well, hopefully you'll all be interested in the latest SPAC I picked up while I was in China.
Oh man, all right, all right, Jay.
Yeah,
Okay.
I don't know if I can compete with this stuff, but it does remind me of the days of going out, in whatever emerging market, wherever we were, and then, the challenges of a morning meeting, with like an hour's sleep and a shower.
Yeah,
But
well, Jay,
those are the days.
Hey, don't feel bad. I once poured about $15 million into a startup claiming to be the Uber of electric rickshaws based in Shenzhen. Turns out it was just two guys, a car battery, and a WordPress site. The founder disappeared mid-roadshow and was last seen pitching a rice NFT in Dubai.
So Jay, look at it
Perfect.
this way: you're the opening act. They came for the Pelosky, they stayed for the Van Drunkenmiller. So there you go.
Yeah, exactly.
So,
Exactly.
all right. So
I'm
okay.
ready to cede the stage though,
I
George.
know,
So
I know,
no
I know.
worries, man.
All right, so wait, so let's get a. So we were talking. I think we were just getting to the point. You were talking about how much the currencies could fall. You're
Yeah.
talking DXY,
Yeah.
but DXY, it's kind of a mishmash. Could we maybe granular, make it a little more granular, like vis-a-vis dollar yen or the euro? Let's just pick on those two. Those tend to be most visible for.
Sure.
Where
Sure.
do you think dollar yen could go? Where do you think, conceivably, not making a prediction, but
Yeah.
conceivably the
Right.
euro
Well,
could go?
I think, yen has more room, for sure. And, I did mention my former Morgan Stanley colleague and former head of foreign exchange research, Stephen Jen, and these numbers come from him. But he thinks fair value with the yen is somewhere around 110 or 100, right? Right now it's at 140, down from 160. The euro is a little bit more, towards fair value, which is, in his view, 120, 125. And then you have places like Brazil where, fair value for the real could be as low as 4.5, where now it's like 5.8, 5.9 to the dollar. So, there are arguably some really big adjustments to the currency. And I do think we're going to, move considerably lower on the dollar. This is it's two things. One is the capital repatriation out of the U.S. from overweight investors who have piled in over the last couple of years when the U.S. was doing so well and everything else was kind of being quiescent at best. And it's the pull of the domestic economies in Europe and Asia doing better, having more aggressive fiscal policy. To us, it's all about the fiscal space that the U.S. used post-COVID is now exhausted. U.S. has no more fiscal space. That's why we're trying to gin up savings to provide room for Trump's 2.0 tax cut. But where the fiscal space exists today is in Germany or in China, where the debt to GDP ratios are in the 60s versus over 100 here in the U.S. And so who has the fiscal space to spend on AI, climate, defense, is going to dictate who has the growth, and who has the growth is going to generate the earnings, and who generates the earnings are going to have the better stock price performances. It's really that simple. And so that's really the underpinning of this. And so that's the strategic outlook. Tactically, the dollar's massively oversold, gold massively overbought. We're big gold fans, big gold miner fans. We have had GDX in our model for quite some time, but it's overbought. So right now it's a little tricky. As I was saying before, I'm not sure if the audience caught that part. Tariff fears are overstated, global growth fears overstated. B of A does that great fund manager survey work showing their latest one shows that people have the lowest, or they expect the weakest global growth outlook in the last 30 years. So we'll take the other side of that. So things have now gotten kind of tilted too far in the near term. But as I was saying, and again, I'm not sure where we cut out, but we want to sell U.S. RIPs because we think the U.S. upside is capped by the Trump discounts we talked about at the beginning. We want to buy non-U.S. dips, given that leadership change is underpinned by the capital repatriation trade, by the better growth prospects and fiscal space available in the different countries. And I'll finish here, George. I know we've been kind of truncated, but hopefully we've gotten a few points across, and you may have some questions, and the audience may. But I want to end here that a range-bound U.S. equity market, which is what I expect, provides the best environment for non-U.S. equity to outperform. Because, again, when the U.S. is up 20% a year, nobody gives a hoot about non-U.S. Why would you, right? I mean, if the market you know best, if you're a U.S. investor, or if you're a foreign investor, it's one that's supposedly safe and liquid and all the rest of it. If it's up 20%, no reason to go into China or Brazil or Germany or France or Italy, etc. Likewise, if the S&P is down 20%, and here's where, as I said before, the title of our monthly Friday, Forged by Fire. In other words, we've had a massive, rapid sell-off and correction. And the non-U.S. equities outperformed both over the last month and year to date. That is telling us that this is for real and we can trust it. And so this environment that we foresee, a range-bound U.S. equity market supported by an okay economy with the thesis that tariffs are going to kind of fade away going forward, be much less worrisome than people are pricing in at the moment, that we think that's a great environment for non-US to outperform. And so that's what we expect. Again, non-US markets, leadership change, secular, not cyclical, going to last for years, going to be supported by better growth in Europe and in Asia based on more fiscal space and commitments to spend on defense in Europe, on consumption in Asia, et cetera. And so that is the outlook. And we think, again, you don't want to look at a year-to-date chart or a 12-month chart. You want to look at 5, 10, 15-year charts and kind of see where this thing could go, because we think it could go considerably higher and last for several years.
So
I'll stop there.
Jay, that was terrific. Covered such a complex and wide-ranging subjects in very succinct terms. So getting some questions here. So basically, where as you said it yourself, I mean, you've had no reason to really look abroad in recent years. The easy thing was just buy QQQ, one-stop shopping, put all put the rest on autopilot. Now, might it be as simple as the opposite? And I don't mean to sound like too much of a wise guy, but Jay, you're old enough to remember when, okay, Japan was king of the pile, and Japan was dominating the EFA indices. For those who aren't old enough to remember when, EFA is the Europe Australia Far East Index. It's the equivalent of the non-US S&P. I guess, I don't know, ACWI J is more analogous to it now, whatever. At any rate, all you had to do was buy Japan and forget about everything. Japan got up to 66% of EFA, and if you didn't own Japan, in particular Japanese financials, you were dead. In recent years, let's face it, if you didn't own the US, in particular, if you didn't own Mag 7, you were dead. Could it be as simple as, and it's certainly been the case so far this year, where the opposite is true? If you just underweighted those stocks and indexed everything else, because Jay, a lot of times when you're running real money, it's not so much what you own. If you just don't make mistakes, it's Michael Chang's, the losers game. Like, just don't make errors, right? If you just avoid, I'm not saying one should short these stocks or whatever, but recognizing they've been the reason for the big outperformance. And Jay, I took the liberty. I don't know if you can see this or not. It's your first time running in the space, but above your avatar, if you see it says
Yep, I
Sears
see
or
it.
George Noble,
Yep.
okay, and you touch on those different images, some of the charts you provided, maybe you could speak to those as backdrop. There's one in there you show the foreign investment. It says the world has a lot of capital tied up in the U.S. You have minus 80% of GDP. That's the U.S. I think net investment position. And the other one I really like was you have total foreign holdings of U.S. equities, treasuries, and U.S. credit. So I know I'm talking too much here, but this whole idea of money going home and the extent to which a lot of this money may have found its way into NASDAQ in particular, and that on top of the great unique characteristics these companies have, what's also been exceptional has been their ability to track capital. And maybe the tide goes out on this. I mean, maybe just talk a little bit about the potential for money going home. You spoke about how the dollar could go down a lot, but these are eye-opening numbers you have here in terms of the U.S. net
Right.
position. And how do these charts
Right.
speak to you, Jay?
Yeah, well, I mean, it's a great way to kind of give the audience a little bit more color on, the work that we do at TPW Advisory. So basically, I spend a good chunk of my day reading, and having been in the markets for a long time, one has the benefit of knowing kind of who to read and who not to read, right, George? I mean, there are certain people who you want to pay attention to and certain people who you don't need to pay attention to. And so as I do my reading and I see charts that I like, we pull them and we put them in a chart book. And then when we write the monthly, we review the chart book. And so just to give the audience an illustration, this monthly, which again we publish on Friday, is available in our Substack, Forged by Fire, had 33 charts and tables. The chart book from which we selected the 33 had 450 charts, give or take. So we're distilling. Our whole process is distillation, right? We want to distill all the information, all the charts and tables into like the purest, the best, the most informative. And I think we do a pretty good job of that because we've been working at it for decades. I've been writing since the Morgan Stanley days back in the mid 90s. So these charts really do speak to me, and hopefully speak to the audience, and they reflect the kind of the great confusion is why would the Trump administration make it so easy for people to decide to go elsewhere, given the depth of the U.S. negative position on things like the investment position that we show in that one chart, right? 80% of GDP. GDP is in the, what, $25 trillion? So you're talking about something like 15, 17, I don't have the chart in front of me, $1 billion where foreigners own more of the U.S. financial assets than U.S. investors own of theirs. And so it's the flip side of the trade deficit. We don't need to get into all the wonky, economic stuff between trade and capital. But bottom line is foreigners own a lot more of U.S. financial assets than a benchmark position would indicate, a lot more U.S. financial assets than U.S. investors own of their financial assets. And so if people get freaky and capital has to reallocate, the U.S. is most exposed. And that's what we're seeing here day after day when you have, stocks down, you have yields blowing out, you have the dollar down. This is not the norm, and it speaks to a repatriation trade. It literally speaks to people saying, you know what, I'm overweight here. It's underperforming. It's really underperforming when you price in my home currency, i.e. yen or euros or reals or whatever. And so I'm going to sell some more.
Yeah.
And so the way we think about it is, as an example, again, we have a model portfolio, our global multi-asset model. It is benchmarked 50% ACWI, so ACWI being all country world equities, 40% Barclays Global Ag, so that's the global bond market, and 10% Goldman Sachs Commodity Index. So if the U.S. represents 60%, or let's call it, 50%, just to make it easy, it is in the 60s of ACWI, to be benchmarked, you'd want to have 25% of your portfolio be in U.S. assets. So your benchmark, you're neutral. Our view is that you should be under that. So we want to be underweight U.S. assets. So depending on what people use as their benchmark, and if they don't have a benchmark, if they're individual investors, then you probably want to have, if you're a U.S. investor, you probably want to be thinking
Right.
about a 50-50 split.
Yeah, so Jay, to translate that into, and again, this is not financial advice. You're not making picks,
No,
but for the
not at all.
individual investor who's not running a guy jumbo portfolio, would you, if they don't want to take too much stock specific risk, would you suggest buying, I don't know, FXI, KWEB, European ETF, or there's certain themes abroad that you would suggest? Don't have to get too granular, but
Right.
beyond just overweight the U.S. I mean, for instance, I think a simple no-brainer one. Again, not investment advice, but to me, totally agree with you on the yen. FXY is an easy one. Just get long
Yeah.
yen. I
Yeah.
mean, why? If you're a Japanese institution, why would you be a pig to go for a 2% yield pickup? In a currency that's falling 2% a day. To me, that just makes no sense at all. So,
Yeah.
like FXY is an easy one. All right.
Yeah.
I don't know if there are any other ETFs that you want to speak to that, and again, this is not meant over a daily or weekly time frame, but instead of just buying, QQQ or SPY or whatever,
Right.
I don't know, the European Financials ETF, EUFN, or the
Right.
European ETF, VGK, or whatever. I don't know if you want to speak to any of that, or you'd rather just not, you just don't want to go there.
No, yeah, that's fine. I mean, we do have FXY in the global multi-asset model. It's been one of our best performing positions. And very low vol, which is great. Low volatility in it. So, and I would say that we do, to your point about a Japanese yen-based institution, I'm pretty sure there was a chart in the monthly that showed the hedged return for a European investor of bonds versus treasuries, because most of the time these folks hedge their their exposure, their currency exposure, if they're big institutions. But that hedge costs money. And when the currency moves, it costs more money. And so what's happened now is that for a yen and euro based investor, a hedged position in US treasuries is a lower returning vehicle than an unhedged position in their own bond market.
Oy.
Because what is happening is that as the fiscal space argument becomes accepted common wisdom in Europe and in China and in Japan, you are having a global bond bear market develop. So our whole thesis in a nutshell is the US equity bull market is going global, and the US bond bear market is also going global because countries are going to be utilizing their fiscal space, spending more, and thus the long duration piece of their respective Bund or JGB or Chinese government bond market are all going to widen. And that's what's happening. And so you have rates are suggesting the US Treasury market's less appealing. You have hedged returns suggesting they're less appealing. You have policy uncertainty going through the roof, which suggests they're less attractive. And you have a guy who's talking about firing the chair of the Fed. So, I mean, it's,
Jay,
it's pretty
Jay,
straightforward.
yeah, Jay, as the saying goes, what could possibly go wrong?
Yeah,
Hey,
it's a
hey,
pretty
yeah,
straightforward
yeah.
process.
So, hey, Michael Kramer, if you're available, do you have Michael? You had a question for Jay Pelosky. Michael, please unmute yourself.
Yeah, I was just wondering, Jay. So, how do you, I guess, navigate the world in terms of everything you've been laying out? If the U.S. goes into a recession, just because what's the saying? If the U.S. catches a cold, the rest of the world
Right.
catches a flu.
Right.
So, how do you kind of do you handicap that at all? Do you price that into how you're thinking about things?
Yeah, I mean, I think you have, again, we go back to what we talked about at the beginning, right? Stoic strategy. Imagine all scenarios, fear none. So yes, that's part of the possibility range, right? We're not of the view yet that the U.S. is going to go into recession. It's potentially going to be the case, but a lot depends on tariffs, and tariffs are, as we said, we think at the end of the day, Trump is going to, make deals to bring things back to where they were pretty much before he started this whole thing, and he's going to declare victory. And that's going to be kind of that. And if that's the case, then you're probably not going to have a U.S. recession. Whether you have a global recession, the idea of U.S. sneezes, rest of the world catches a cold, okay, fine, that's normally the case, but we're not in normal times, right? We just made the argument that Europe has fiscal space, that Asia, China has fiscal space, and they're going to use that fiscal space. And therefore, their growth outlooks are less dependent on the US than historically has been the case. And so you also have monetary policy space, right? The ECB just cut rates last week. They're going to cut again. They can cut because A, inflation is close to 2%, and thus to their target, and B, the euro is strong, right? So the whole thing, Mike, the whole idea that other countries can't, are hamstrung by the decisions of the U.S. is not valid in this current context, right? EM countries can cut rates because the dollar is not strengthening, it's weakening. That gives all the policymakers around the world space to do what they need to do for themselves without fearing that rate cuts will lead to currency collapses, which has historically been what's happened. The shoe is on the other foot. The fiscal imbalance is in the US. It's not in Europe. It's not in Asia. And this is the whole point. You have to reorientate yourself. You have to think differently. And again, that's something that we have been doing for years at TPW, because our whole framework is to think globally, to think about European integration, Asian integration. When she goes around Southeast Asia and talks about Asian family values and reminds those countries that China is the biggest trade partner, the biggest source of imports from their countries, way bigger than the United States. Even Japan, right? I mean, Japan was supposedly going to roll over and do a deal with the U.S. last week. Well, guess what? China is a bigger, more important market for Japan than the U.S. Same for Europe, by the way. China is a more important market trading partner for European Union than the United States. And by the way, China is not the country that's going to Europe and saying, hey, dudes, you're on your own. Good luck with that. That's the U.S. who's doing that.
Yeah,
So, sorry, just to finish the
yeah,
point, because I think it's
yep,
big and important.
Yep.
From a tripolar world point of view, what we're starting to think about is Europe and Asia integrating themselves, doing more with each other, and the U.S. on its own. And the U.S. on its own is a very, very different place. It's a cheaper, poorer, less successful place. You can't do it all alone in today's day and age. You need regional partnerships. You need regional integration. And what Trump is doing is he's accelerating the European integration. He's telling them they got to fund and defend themselves. So they're going to spend trillions to do so. And by the way, they're going to do it all or most of it by buying from European producers. And in Asia and China, they're basically saying, you know what, we don't like Nike anymore. We don't need Apple phones. And by the way, Teslas, so yesterday, right? We're talking BYD.
Yeah, Jay, if we could just stay with that, there's 2 points I wanted to put to you. First one, just an elaboration on what you were saying. You've dealt with these, you've been investing globally for decades. You've dealt with the Japanese, the Chinese, the Europeans. And in particular, when you see how their reaction to how they've been treated by the U.S., these guys have long memories. And for many of them, it's a question of, honor and trust. And it's as if you're in business with somebody, your business partner or vendor you're dealing with. Once he screws you over, it's never going to be the same. I mean, even if I may either say, you know what, I'm done. I'm not doing any business with you anymore. Or if you do, it's going to be under different terms, and you may try to
Cash
minimize.
on the barrel.
Yeah, exactly. So as Michael Howell said last Thursday, he brilliantly put it. We had him in the space. He said, the U.S. may or may not win the trade wars, but more importantly, it's going to lose the capital war. And that really resonated with me.
100%.
Yeah. So this kind of irreparable damage has been done here, no? I mean, it's kind of hard to put on people.
Irreparable from a point of exceptionalism.
Correct.
U.S. was for exceptionalism, and it's proving day in and day out it's not exceptional.
Exactly.
It's not exceptional. And so the valuation is not sustainable.
Exactly.
And therefore it's not sustaining.
Yep.
And you're going to get a gradual erosion of that premium across all the financial assets. That's why I started out the very first point, right? Investors need to assign a Trump discount to U.S. stocks, a Trump premium to the cost of capital, and a Trump discount to the value of the dollar. That is the whole point. And yes, it's going to sustain itself. And again, it's push and pull. Trump is pushing people away from the U.S. And the other countries are making policy decisions and actively responding with Germany as a prime example in Europe and European defense stocks, right? You talk about things you like in Europe. Well, European defense stocks are a no-brainer. Any kind of pullback, that's where you want to be looking for opportunities, because that's a decade-long process where the Europeans are going to establish their own capacity to defend themselves. And then similarly in China is going to establish its own, it already has its own tech ecosystem, which is why, to us, the people talk about rotation being the lifeblood of bull markets. Well, we are in an epic rotation in a global equity bull market out of the US, out of US tech into China tech, into the rest of the world. Now, having said that, tactically, US big tech has derated aggressively. And there still is a real story there. This is not, the dot-com bust. not anywhere close. But what it means is, US companies are going to have the US. Chinese tech companies are going to have China. And really the fight is over who's going to have access to the European tech market. And that's why, as I said earlier, what we're thinking about is Europe and Asia becoming closer together while the U.S. self-isolates. And the fact that we're going to have Trump in office for 4 years, right? We're in month 5. So that in itself suggests this is secular.
Got it.
And sustaining, because it's highly unlikely he's going to completely reverse direction.
Got it.
So the U.S. is going to basically bleed out that premium valuation. The dollar is going to go towards fair value. EM right now, for example, trades at like 10 times earnings. China trades at 10 times earnings. So, our whole thesis is that growth is going to be better. Earnings are going to be higher. You're going to get not just the earnings growth, but also multiple expansion because valuations are very compelling. Ownership is very low. And so, real shorthand, we think the U.S. will have single-digit type returns, again, kind of range trading, really good environment for non-U.S. because that's when people will start to really look abroad. And the non-U.S. equities can average kind of double-digit type returns, teens type returns, based on earnings growth plus multiple expansion plus currency appreciation.
Terrific. All right, so Jay, take a deep breath. We've got I've got my good friends. First, we're going to go to Rob Isbitz and then Bitcoin Tina. Rob, please unmute yourself. Floor is yours.
Yes. Jay, first of all, congratulations on using Trump and discount in the same sentence. I don't know if we've ever heard that before. I will tell you this, it's been 30 years. You have not lost your fastball. You don't remember me, but I remember you. 93 to 95, I was at Morgan Stanley in New York, and you were up there with Barton Biggs and Byron Wien and Steve Roach, and you're always very approachable to a young kid in the business, me, and I'm still in it, so thank you. You're part of my education. A quick question. Blocking out the rest of the world. Asia, Europe is where people normally go when they think international. But what about North America? US, Canada, Mexico. And I guess I'd put it to you this way, answer it in whatever form you like. Let's say 3 to 5 years ago, if I had said to you, my mandate is US, Mexico, Canada, and I allocate between the three, how would it have been 3 to 5 years ago, and how might it be changing now?
Well,
Equity.
that's good. Yeah, no, great, and thank you for that memory. It's those were the days, right? Morgan
Yep.
Stanley back in the 90s. I was back in those days. I was the young guy with Barton and Byron and Steve and all those guys. But yeah, it's all good. I actually had lunch with Byron's wife, Anita, just this week. So
Oh, the
still
best.
keeping in touch with the firm and some of the folks there. So yeah, no, great question. And 5 years ago it would have been just buy the U.S., right? I mean, Canada not really. It's a resource market, and Mexico, similarly, kind of a production offshore production facility. And that was, actually that North American, the NAFTA thing was the precursor for us of the tripolar world, because you had the U.S. as consumer, you had Canada as a natural resource provider, you had Mexico as a low-cost manufacturer, and that was in early days kind of the thinking around the regional integration. And of course, Trump has, while Asia and Europe are integrating more quickly, as we just talked about, Trump is busy blowing up the North American integration that has been building since those days, the mid-90s, 30 years or so. So that makes absolutely no sense. Strategically, in a world where regional integration is going to be the driver, blowing up your own region and accelerating other regions' integration is obviously not a strategy for success. Having said that, I think it's really interesting to look at like ILF, for example. Again, yeah, not
Latin
recommending
America.
things, but
Yep.
Latin America, because as I touched on earlier, for all the talk about Mexico and tariffs, et cetera, Mexico has done fine as a stock market. The peso has done fine. And Brazil is a big beneficiary, could be a big beneficiary. And those are the two main equity markets in IOF and in South America. Mexico and Brazil make up about
Yeah.
70% of that ETF, maybe 80%. And so, Brazil's only tariffed at 10%, and you're starting to see already as companies game out, a future where some of these tariffs may not be reduced sharply. Brazil is starting to look really interesting as a production base because it's only got a 10% tariff on it. And at the same time, China is busy buying food and protein from the Brazilians instead of the American farmers. So, you look at Brazil, you have big China demand on the ag side, and they have the ability to fill that demand. And you have interest from Asian producers who are thinking about where can I set up production quickly to get into the U.S. that's not being tariffed aggressively. Brazil stands out big time. And you have Mexico, which again has already had all the bad news thrown at it, right? What more are you going to say about Mexico that's going to create another big downdraft in that market? And so, yeah, I think you're absolutely right to be thinking beyond Asia. Look, we're overweight non-U.S. equities in our global multi-asset model, as we were talking about earlier. We're overweight both DMX US, so Europe and Japan. We're overweight EM, significantly overweight EM, so double to triple weighted. And that's a combination of Asia and mainly China, and other parts of the EM space, including South America and Eastern Europe.
So Jay, you're basically saying just get out. I mean, underweight the U.S. is bottom line. That's a big message.
Yes,
All right, fine.
100%.
All right.
Yeah.
All right. Thanks for that, Rob. I want to keep moving. Bitcoin Tina, please unmute yourself. You had a question for Jay, Bitcoin?
Yeah, two questions. One, any suggestions as to how we can figure out the ETFs that we might want to own in any kind of size? And do you know VT from Vanguard? Do you have any
I
views on
don't.
that? That's world. It's basically every stock in the world.
Mm-hmm. Yeah, I don't know it, but I would look and see what if it's every stock in the world, then you're buying the bulk of it's going to be U.S.
Yeah.
And so
60% US.
Yeah, Tina. No. If you want, look, Tina, you and I can talk offline. Stay away from that. It's too much U.S.
The other thing I would say is that you can become a client of TPW Advisory and access our model,
Right.
which you can go on our website Pelosky.com and learn more about that there. But yeah, that's what we do. We build a portfolio of roughly 30 ETFs that are global, are multi-asset. So there's stocks, there's bonds, there's commodities in there, and again, all U.S. listed. And all liquid and available. So
yeah, and
that's one solution.
Yeah, and Jay, I've
Become a client.
Jay, I've been remiss because usually I always suggest.
No worries.
But you've been providing high level institutional research to the biggest of the big clients out there for decades. Can you just tease out a little bit more? You've come out recently with a Substack. If the individual investor that's not Millennium or whatever, what's the product that you now have on Substack, and how can you help the individual investor?
Sure. So again, as I talked about, we are big believers in a framework. Framework is the tripolar world. Our thesis that regional integration in Asia, Europe, and the Americas is what's going to drive the global economy going forward. Everything we've seen in the last couple of years, from COVID to Splinternet to Europe, you're on your own in defense, is driving towards that regional integration. So that's our framework. We think it's something that differentiates us, that's unique to us. It's our own IP. We've been evolving it for 15 years. We then have a structure, which I touched on, our global risk nexus, and we have a process, which is we write every week. And that's what's available on our Substack, the every week writing, available for paid subscribers. And it includes other things like TV appearances and podcasts and things of that nature, stuff like what we're doing here with George. And then we also offer a model portfolio delivery service, where we provide once a month an updated model available for a fee that you can find the information on our website, Pelosky.com. And that process has been ongoing for years. It includes a monthly call with me to discuss the model changes. And as I say, we benchmark the global multi-asset to ACWI, Barclays Global Ag, and Goldman Sachs Commodity Index. And there again, we are paying attention to commodities. We like commodities.
Yeah. And so
commodities are really interesting. Sorry, George,
Yeah.
just to elaborate for just a second. In a world where inflation is going to be slightly higher because fiscal space is being utilized in Europe and in Asia, in a world where the dollar is weakening, we want to be invested in commodities. And so, what's interesting to us is ag. What's interesting is precious metal miners. Gold, I already discussed. What's interesting to us is clean energy. So this is where we bleed into our second model, which is our TPW 20, which is a thematic higher beta model focused on future innovation and climate change. And one of the things we've been noticing there is that clean energy, which has been left for dead. We had a chart in the monthly on clean energy as well, down like 80% from its highs in 2021, starting to outperform nuclear power and outperform fossil fuels like XLE. And here's why. Okay, again, we have climate as the first thing in our global risk nexus. So we pay a lot of attention to this and have for years. And what people are starting to realize is that the data center build out, which we think is for real, we are believers in the AI age. The data center build out in the next 5 years is only going to be powered by renewables plus batteries. Okay? Not going to be nuclear power because it takes way too long to get a nuclear power plant permitted, built, and operational. So yes, there will be some extend of life. There will be some mothballed plants coming back online, but it's not going to be the solution. Gas-powered power is also not going to be the solution. You go out to Siemens, which is one of the leading gas turbine manufacturers, and tell them, hey, we're doing a data center here and we need power, and I'd like to order a gas turbine. They will tell you it will be available in June of 2030. There's the waiting list. You can't order a new turbine today and expect delivery before the next decade. And so people are starting to cotton on to renewable power, renewable energy as the solution with batteries. And the technology in batteries, as you see from the EVs, is rapidly improving. And thus, clean energy, renewable energy is starting to outperform. And so that's a core holding in our TPW 20 thematic model. And we added it to the global multi-asset model last month. And it's one of our top performers over the latest month.
And Jay, just to be clear, people should not misconstrue your last comment about favoring the electric car company that shall not be named. You have a strong. I have a strong preference for BYD. I presume you're likewise. You had a chart which showed BYD way outperforming Tesla, and I just don't want people to get the wrong idea that you're suggesting to get long Tesla. By the way,
No.
for everyone in the room, Tesla's having earnings. I think after the close today, if I'm not mistaken. Pay no attention to the earnings. One can be rest assured that Mr. Musk will come up with some more creative prognostications about robot day or how many self-driving cars are going to have or yada yada yada. Also, as Shakespeare once said, the quality of earnings is not strained. Be careful to pay no attention to the headline number. Be careful to look at the EV credits and all the stuff below the line. So as Jay was saying before, it's not the news, but the reaction to the news. That's an oldie but goodie from Stan Weinstein. Wouldn't surprise me if the stock pops in the short term because it's gone down in a hard way. But I think this continues to be a great investment short. And as Gordon Johnson said a few weeks ago on our YouTube, Tesla will probably go down in history as the biggest destruction of wealth in the history of stock markets. But again, this is not financial advice. Jay, if you don't mind, don't worry, I'm not exposing you, but this is hilarious. I want to play a 45-second clip from our YouTube interview a few weeks ago, and hopefully the sound quality is good enough we can hear it. But and if not, I'll put it up in the nest. But towards the end of the interview, okay, you said a couple things. I mean, you made us hysterical. Michael and I couldn't stop laughing. You were talking about Trump's financial acumen and his the fact that he's a serial bankrupter. I just want to play that 45 seconds here if I can. So just bear with me. This is like one of those Project Veritas hot mic moments we get Jay Pelosky saying what he really thinks about Trump. But this is art imitating life. The funny thing is, this was spot on the money. So let me just play this. Let's see if this works. Hold on.
Anything else. And as you pointed out, Doge is really just performative for the most part. And tariffs, every time he tries to really push aggressively, the other countries now know the game and they push back and he folds. I mean, this is a guy who's a serial bankrupter, right? For all the art of the deal, he is a serial bankrupter. So, could he bankrupt the country? Could that be the crowning success of Trump? Let's hope not. Certainly, but I think that there are going to be levels that the administration is not going.
Jay, you had me cracking up when you
Yeah, I
said
can hear you
that.
guys laughing in the background. It's
Yeah,
pretty
I know.
funny.
You want, okay, but it's
And now
like
people are talking about that
I
as a real
know,
thing, though,
I know.
right?
But
I mean,
and Jay, the funny thing is, again, getting away from the humor. When you have a declining credit, say you're a bank, what do? You change, you tighten up the credit lines, you raise the rate. I mean,
yep.
that's what they're doing to our bond market. That's what they're doing to our
Yes.
currency. It's exactly
Yes.
what's happening.
Yes, it is, and that's what we've spent a lot of time talking about. And just to go back and again, this is a nice segue. Okay, that's what's happening in the U.S. You really can't argue that point after the last month, right? Since Liberation Day, you really can't argue.
Jay. It's liquidation day. Get it straight. It's
Yes,
liquidation.
exactly.
Go on.
And it's opportunity day to buy the non-U.S. stuff. And so you were talking about BYD earlier. And look, we have been on the idea that China has mastered what we call the new industrial policy mix, which is public and private partnership, fiscal and monetary policy, all working together, executing at a high level to control and dominate the key highlands of the global economy going forward, which are renewable energy, AI, and defense. And that's why we talk about those three as being critical components to spending. They are existential. People have to spend on them. Europe has to spend trillions on defense. China has to spend trillions on AI. Everyone has to spend dramatic amounts of money on climate mitigation. And so China has led the way in the renewable space such that they dominate the entire renewable space from solar to wind to battery to EV. They dominate the entire space. It is game over. And now the game is shifting to AI. And that's why we think there's a global growth long cycle unfolding that is going to support a global equity bull market through the earnings channel. And that is going to be driven by the spending on AI, on climate, on defense in Europe and in Asia. And that is, BYD is the symbol of a industrial policy mix that has been executed at a high level such that it's game over. And so when people talk about tech and AI, DeepSeek was not a surprise to us. We were invested in KWeb before DeepSeek because it's very simple. China will spend whatever it needs to spend and will do kind of whatever it needs to do to have AI capacity, because you have to have AI capacity. And Europe is going to do the same, belatedly. But this is all spending that is going to support the global economy and support equities.
Great. All right, I'm going to get one last question. Rusty, my good friend, I yield to Rusty, and then we're going to close the room. Rusty, the floor is yours. Please unmute yourself.
Hey Jay, I really appreciate your time and input. I was curious, you got BYD. What about CATL? What are your thoughts on that?
Yeah, I mean, again, we don't do individual stocks, right? We're ETF, 100% ETF focused, but we're aware of these companies because they're big components in several ETFs that we are invested or have been invested in through our models. And so CATL is the battery play, right? They're the leading battery provider. And so that whole ecosystem in China, I mean, if you pay attention to it, it's much more aggressive and capitalistic than what happens in the US. Because the Chinese, the way they've operated, and this is now changing, but for the last 5 or 10 years, every kind of provincial government has helped fund a battery producer or an EV, or what's called in China NEV, new energy vehicle. And so they're it's like the early days of the auto industry in the US 100 plus years ago. There's 20 or 30 competitors in EVs and in batteries and in solar and in wind in China. And they just, they compete against each other so aggressively that there's massive incentives to drive down prices, which then when these companies go global, they can provide a product at a price point that nobody else can even come close to. And that's literally what's happening. And that's why they dominate the space. And now what's interesting is that China is going from quantity to quality. And so they're basically trying to reduce the number of competitors. They're not providing, capital access. They're encouraging M&A. They're encouraging mergers. They're telling local governments, you got to stop providing competitors in every space and do things smarter and better. So there's a real shift to quality from quantity. But in essence, yes, I think one of the interesting opportunities right now is this idea that clean energy, renewable energy, is going to be the fix for data and power demand for the next 5 years. That to me is a very interesting opportunity. And as I said, we got it because we look at the charts of our holdings, on a regular basis. And those holdings are outperforming not only nuclear, but fossil fuel over the last couple of months. And that's a tell.
Thanks so much.
Right?
Thanks so much,
The
Jay.
outperformance.
Thanks, Jay. Thanks, Rusty, for the question. We're going to close the space now, but I just want to point out to everyone in the room, Jay's focus, as opposed to most everybody else we have in these spaces. Jay is a global globetrotter, for lack of a better word. And very few are really looking at what's going on outside the U.S. So Jay's the real deal. The world's a big place. There's life beyond QQQ. If you want to extend your focus and venture abroad, as I think you should, please follow Jay on Substack. I think his product he's come out now for individual investors is terrific. And I think if you want to get the whole picture, especially if Jay's right, and I think he's going to be right in the years to come, trying to do eeny, meeny, miny, mo, and your big ass allocation decision, instead of being, do I overweight Apple or Nvidia or Microsoft, it's going to be, do I want to be in China, Asia, or Latin America? That's where the real money is going to be made. And so, Jay, I can't thank you enough for coming on. I hope we do this again. You're providing a real service for everybody. I hope you enjoyed it. Sorry about the technical glitches, but that's life. Welcome to the hellscape. That's Twitter, which is why we may relocate these broadcasts at some point.
No worries, George. It's been great. Great questions. Great to be with you and Michael again. Thanks for the
Our,
opportunity. And
yeah, our pleasure. Our pleasure. And just one other announcement. I mean, Dilly, you want to talk about what we're thinking about possibly moving the time of this space, Dilly? Dilly, I don't know if you're still there, but we were talking about possibly moving these spaces from 8 a.m. to 4:15 p.m. And so, if anyone has thoughts about that, please put comments in the pillbox or respond to Dilly or myself. The one other housekeeping note: we're not doing a space tomorrow morning. Jay, I presume you know Jordy Visser. Another
yeah,
okay. We're
sure.
having Jordy at 8 a.m. on Thursday. If you want to listen in. So I know this is Morgan Stanley week, but the suggestion
Yeah,
the
exactly.
suggestion was made, by the way, that I should get Jordy, you, Adam Parker, and Rick Bensignor all together to do like a panel, which that might be fun. We'll see how that goes. But
Yeah,
but
no, Jordy's a great guy and a
he's
great guy to listen
he's a
to for
great thinker.
sure.
So he's going to be on at 8 on Thursday morning, and Jay, we're going to have to splice together these replays. I'll figure it out, and we'll send it to you so you can get the whole. You just one replay on your Substack.
Yeah,
So
perfect.
again, Jay, thank you
Perfect.
very much. Thanks for everyone. See you guys on Thursday morning at 8 a.m. Take care, everybody. Bye bye.
Thanks,
Bye.
George. Bye bye.